This is Nightly Business Report with Sue Herrera and Bill Griffin.
Good evening, everyone, and welcome to this special edition of Nightly Business Report. Tonight, we're going to look at a number of issues important to your money, including the stock market, the future of the workforce, and your retirement.
And we begin with stocks. The incredible quarter that we saw for Wall Street. January, of course, was defined by a stock market surge, but that enthusiasm faded in February and gave way to the return of volatility in March. So on this last day of the first quarter, it's already there. What can investors expect in the second quarter? Seema Modi takes a look for us tonight.
The first quarter of 2018 has been active, to say the least, for investors. Triple-digit swings, volatile moves, and changes in policies that have economic implications. In the second quarter, expect Wall Street to stay focused on Washington. On the topic of trade, investors will be keen to figure out whether U.S. relations with China, a large trading partner, will strengthen or weaken. Heightened rhetoric on trade protection is expected to continue, escalating worries of a trade war. When it pertains to taxes, economists will be keeping a close eye on the data to see whether a reduction in the tax rate is starting to have a positive effect on consumers. If we don't see an uptick in spending or consumer confidence, that could push Wall Street analysts to bring down their growth expectations. Currently, analysts are anticipating the United States to grow 2.5% to 3% in 2018. With growth in focus, the market is anticipating another 25 basis point rate hike from the Federal Reserve in the second quarter. While rising rates are not always good for stocks, traders say equities can continue to power through if earnings growth improves. If profits don't surprise to the upside, the bulls may find it hard to stay in control. But analysts at Thomson Reuters are expecting earnings growth to strengthen in the second quarter, led by technology and financials. Perhaps most important to stocks is the direction of the U.S. dollar, which continues to weaken in the face of strong economic data and protectionist moves out of Washington. If the dollar reverses and creeps higher, that would present a headwind for multinationals like Apple, McDonald's, and Nike that depend on growth overseas. For Nightly Business Report, Seema Modi.
Let's turn now to our guests for their second quarter outlook and the market and the economy. Joining us is Jack Ablin. He is the Chief Investment Officer at Crescent Wealth Advisors. And Beth Ann Bovino is the U.S. Chief Economist at S&P Global. Welcome to you both.
Great to be here.
Thanks, Sue. Jack, let me start with you. Overall, what are you expecting? And you say that basically we are seeing some liquidity, which is positive, but it's under a little bit of pressure. So how does that translate to your overall outlook?
Yeah, so right now we haven't taken the opportunity with this volatility to sell or buy, for that matter. We're pretty much holding the positions that we have. We are pretty well fully invested going into this year and holding through. But there are some concerns. There are some things we're watching. One, as you mentioned, is credit conditions. That's sort of what we'll call the circulatory system of our financial system. And we look at the availability of credit. And over the last couple of weeks, we've started to see incrementally lenders starting to tighten up a little bit.
Beth Ann, we saw technology, which has traditionally been a leadership group in this market, falter during the first quarter. Do you see that continuing into the second quarter? And if so, who becomes the new leader, do you think?
Well, I think there's a lot of factors that are happening with the technology, what happened with the technology stumble, I guess you could say. A lot of them were company specific. I think, though, and also you would say that the tariffs tied to China response to the U.S. and back and forth, I think that also caused some worries. I think overall, though, when we're looking at what's happening with the U.S. economy, we do see that spending is going to pick up, and we think that equipment spending will pick up as well, and that should be a boost for technology companies going forward.
So, Jack, take me through how this whole situation is going to develop for the economy. You said you're fully invested, but you're looking at some of those liquidity issues. But as Beth Ann just pointed out, the economy is kind of firing on all cylinders, and the global economy looks very strong.
That's it. So if you look at really the five factors we look at in evaluating the market, valuation is actually pretty fair value right now. We started the year relatively expensive, and I think a combination of the pullback plus improvements in earnings outlooks have actually brought that back within 5 to 6, 7%. So I think if a 5 or 6% overvaluation to me is considered neutral. As you mentioned, the economic backdrop, positive here at home, positive even more so abroad. I think that's a great environmental factor. Liquidity, as I mentioned, still easy, but I'm getting a little bit worried. Now, here is a case. This is an early warning indicator. If you go back to the downdraft of 2008, the financial crisis, liquidity dried up in the fourth quarter of 2007. So it's a really good early warning indicator that lenders are pulling back, and the availability to take risk is minimized, or I should say, reduced. And then psychology, I would say it's a mixed bag. Investors now somewhat, going into the year, were overwhelmingly bullish with high expectations. With the volatility we've experienced, they've pulled that back. Okay. And then lastly, momentum. We've bounced off the 200-day moving average twice. We still have positive momentum, but if we do get a breakdown, and perhaps that's paired with a pullback in liquidity, that would drive us to at least pull some of our risk off the table.
Beth Ann, you expect the Fed to raise rates, 3 more times this year? Will that be a headwind at some point for those interest-sensitive sectors, or is this just a confirmation that the economy is going to get better?
I think it's a confirmation that the economy is going to get better. We're looking at this economy as the fundamentals are looking very good. Businesses are hiring. We saw some really nice readings. We continue to expect for the year about 200,000 job gains for the year or thereabout. We think the unemployment rate's going to stay low or go tick even lower than that. And we think this just gives the good reason for the Fed to start to raise rates. They seem to indicate that they're going to do it gradually. Yeah, maybe a little faster than maybe what markets had hoped, but I think they're going to take their time. And the point is, they want to do it now because if they wait too long, they're going to have to go move too fast, and that's going to spook the markets and the economy.
On that note, thank you both, Jack Ablin with Crescent Wealth Advisors and Beth Ann Bovino with S&P Global. Bill?
Well, certainly a key part of the economy is housing. Today's competitive market means more homeowners are staying put. They're remodeling instead of moving. But which improvements give you the biggest bang for your buck? Diana Olick has the answer for us.
Emma Chanlett Avery has a vision for her family of 4.
We can just move in.
And it's getting there. She and her husband are enlarging the kitchen, adding a family room and an upstairs master suite. More space was paramount, even if the cost outweighs the returns.
It was a balance because we always had the possibility of resale in our mind, but we think we're going to be here for a while. So mostly we were focusing on the things that would just make our life here with our family better or more comfortable.
Homeowners are staying in their homes longer today than in the past, upgrading and remodeling more, and some projects nearly pay for themselves. Garage door replacement will give you 98% of your investment back, according to Remodeling Magazine's annual cost versus value report. It asks real estate agents how much a renovation would add to the sale price of a home selling in the same year. Manufactured stone veneer came in second, and a steel front door ranked third. Other high returns, a deck addition, and a minor kitchen remodel.
Things that like kitchens, bathrooms, you're probably going to get 60 or 70 cents on the dollar for those types of investments. And then things that are more decorative, generally speaking, you're going to get a little bit less on those.
Doing a simple remodel or upgrade will give you a better return than an addition or something fancier, and that's a big change from last year. Why? Because the costs of labor and materials are both skyrocketing, and that shifts the equation. Of course, value can be subjective depending on how long you plan to stay.
If you're going to live in a place for 10 or 15 years and raise a family, you're still going to get that money back, plus the intrinsic value of living there, enjoying the additional space.
As with everything in real estate, location matters. If home prices are rising faster in your market, then remodeling returns will be higher. But no matter where you are, remember, before you pour your life savings into it, your dream kitchen may not be someone else's. For Nightly Business Report, I'm Diana Olick in Washington.
Still ahead, the labor market is strengthening and the workplace as we know it is changing. The manufacturing industry is experiencing a solid turnaround, but a tight labor market is making it difficult for companies to find more skilled workers. It's a problem that one manufacturer in Indiana is trying to solve. Kate Rogers reports on where the jobs are.
Since the election, manufacturers have added jobs, encouraged by deregulation and corporate tax cuts, as well as stronger global growth and a weaker dollar. But this job growth is facing one major headwind: a shortage of skilled workers. It's particularly evident in Indiana, where reliance on manufacturing is outsized relative to other states, with 20% of all employees working in the industry.
We have had a record number of job announcements over the last 12 months, but it also creates issues in trying to get people to come to Indiana and work here.
On top of that, a population issue. The Indiana Manufacturers Association has even floated the idea of creating financial incentives to lure workers to the Hoosier state to fill vacancies.
We need people to move to our state. It is estimated that our workforce population is going to grow by 1% between now and 2040, and the national average is going to be 18%.
It's an issue steelmaker ArcelorMittal knows all too well. The company employs 18,000 workers here in the U.S. and is looking to add an additional 1,000 employees in 2018. But attracting talent in a tight labor market can be challenging, which is why the company created its Steelworker for the Future program.
It's really a partnership of us with high school graduates where we assist them with their college education, but also provide for them the opportunity for hands-on training in our factories.
The steelmaker has hired 90 former participants and currently has 144 students enrolled. Dantrell Brooks is a recent graduate.
My senior year of high school, everybody's talking about big name college universities, going there 4+ years to get a degree. Well, I saw ArcelorMittal as a 2.5-year degree, less than half the time, guaranteed job, training, craft, and I knew I had to go for it.
From engineers to technicians to supply chain managers, ArcelorMittal is recruiting heavily and hoping to usher in the next generation of talent like Brooks.
This job itself is the #1 job out there.
For Nightly Business Report, I'm Kate Rogers in Burns Harbor, Indiana.
Now, in an era marked by rapid changes in technologies like automation, robotics, artificial intelligence, how will it shape how we work, where we work, and the skills that we will need in the future? Joining us tonight to look at the future of work, David Mindell. He's the CEO of a technology company, Humatics, and a professor of engineering and manufacturing at MIT. Mark Hamrick is senior economic analyst with Bankrate.com. with their views. Mark, I'm going to start with you, and I'm going to set technology aside for a moment and look at demographics. I know you're interested in that. Since the financial crisis, a lot of older workers have found themselves out of a job replaced by younger, cheaper workers. But we have a very tight labor market right now. Does that help the older worker in the future? What do you think?
Well, I think, we have greater longevity in this country, and that's the good news and the bad news. Leaving aside the question of whether their prospective retirements are well funded, those older workers are going to be a great potential resource for enterprises in the future. There will be competition between younger entrants in the workforce and the older workers. And of course, we know that the baby boomers, as they're currently retiring, are being replaced by less expensive workers, and that feeds into a whole other set of dynamics.
Yeah, it certainly does. And David, there's also the thought out here, I don't know how many times I've heard this, that the workers of today and the workers of tomorrow will eventually be replaced by robots or some other sort of machine type technology that can do the job. But you make the point that we might not be replaced, but the work experience might kind of be augmented by these machines and by these robots.
Yeah, I think that's correct. There's been fears for a long time, centuries, that people have been replaced by machines, and in certain tasks they are. In the economy overall, often automation or mechanization or roboticization creates new tasks, and people are very flexible, very able to take on those tasks, and increasingly we're understanding how to use AI and machine learning and artificial intelligence to make robots more collaborative and make them better able to work alongside people, and that's a huge new frontier.
David, Jeff Bezos loves artificial intelligence. He employs it with his Echo device, but Elon Musk fears artificial intelligence. Where do you stand?
Well, I think, artificial intelligence is displaying a lot of promise. It's still very heavily dependent on data. It's still very dependent on human labor to tune it and fine-tune it for particular purposes. It's It's very good at focused tasks that we understand pretty well. It's not quite yet there where it's able to do something entirely new and explain to you why it did it.
You know, Mark, can I turn to you on the whole focus, and it kind of dovetails with what Bill was just talking about, the divide about whether or not artificial intelligence and robotics are going to be net good or bad. But the one thing that people seem to really focus on is the need for further education on many different levels, so that you can deal with AI, deal with robots, and also deal with the hands-on manufacturing that has to be done.
Yeah, that's clearly a challenge and an opportunity. These emerging technologies, I think we sometimes don't sufficiently appreciate the disruptive nature of them. So while we might say that on balance, technological advancement is a very good thing, in the near term, it causes tremendous disruption, which presents itself into the political process. And I would dare say that I think that is one of the biggest wild cards for the future. Where do societies and countries end up dealing with policy to help the people who are displaced? And in the earlier package, one of the answers is not requiring everyone to attend 4 years of college or universities, for example.
Right. Before we let you go, gentlemen, and Mark, I'll start with you. If you had to pick an industry, you're telling a college graduate, this is where the growth is for working in the future, where would you tell them to go?
Well, healthcare will account for about 1/3 of the service sector jobs that we see in the future. Again, going back to that aging population, there will be no doubt technological improvements which supplant some of that labor, but you'll still need humans to carry out those processes. So about both the low skill and the high skill aspects of healthcare, those jobs will be needed.
David?
I'd say any area where you have people that require an interface to a complex technology, that's always a place. It's in healthcare, it's in lots of other systems. We're always going to need people to help interface to other people.
All right, David Mindell of Humatics and MIT, Mark Hamrick with Bankrate. Thank you both. Very interesting.
Thank you.
Thank you.
Well, it is no secret that Americans need to save more for retirement. According to Bankrate, a recent survey shows that 1/5 of all Americans have nothing saved at all. But now one state is stepping in to help fill the savings gap. Sharon Epperson has our story tonight.
The beers that we have on tap are on the top.
When small business owner Josh Allison decided to go from a career in biology to beer, his focus was crafting the perfect pint. Giving employees a way to save for retirement may have been a goal, but not one Allison was able to brew up on his own.
You spend a lot of time, a lot of energy working with these people, developing relationships, and they become family. And you really want the best for them. You want them to be able to provide for themselves later in life.
Now, thanks to a program that is the first of its kind in the country, employees at Reach Break Brewing are given the chance to save for their future through a state-run retirement plan called Oregon Saves.
We're giving small businesses the same kind of opportunities that some of the larger businesses have. Low-cost savings for employees at no cost to the employers.
About 55 million American workers in the private sector are not offered a 401k plan through their employer. Most of them, 32 million, work at small businesses, which have fewer than 100 employees.
Some may say, why is that a problem? Study after study shows that people are 15 times more likely to be saving for retirement if they're offered access through their employer.
Oregon Saves requires employers who do not offer a 401k to automatically deduct 5% of an employee's wages after taxes and send it to their individual retirement account, or IRA. Workers can contribute a maximum of $5,500 a year. The plan is managed by the state, and workers must opt out if they don't want to participate. But so far, many being given the chance are doing it.
There are about 20,000 who are somewhere in the process when their pay periods take place. And in the end, we expect that there will be about 1 million people who could potentially participate.
Reach Break's taproom manager, Chris Merle, who's contributing 5% of his wages to his plan, says this is the first time he's saved for retirement.
It's always something that's kind of in the back of your mind, but you always kind of use your youth as an excuse and say, oh, I can just always do that later, and now it's later.
Critics say there is too much paperwork for companies that already offer 401k plans. Yet more states are following Oregon. 7 have enacted legislation for their own retirement plans, with Illinois and California expected to roll out theirs this year. Another 24 states have introduced legislation to start their own retirement plans.
We're hopeful that other states will see the success that Oregon is having in designing and rolling this program out and make similar programs available in their states.
Josh Allison hopes offering a retirement plan will attract the best employees who will help ensure customers keep coming back.
One thing that the savings plan will allow us is people will be able to view this as a long-term career rather than just a stepping stone.
For Nightly Business Report, I'm Sharon Epperson.
Cheers. Coming up, the sale of the century that allows you to shop like a Rockefeller.
The legendary collection of the late David Rockefeller is scheduled to be auctioned off at Christie's in May. The items are expected to go for a record amount, with all the proceeds given to charity. Robert Frank was given a rare look at the pieces by David Rockefeller Jr.
No other name in American history symbolizes great wealth and status like the Rockefellers. Now, to their achievements in business and philanthropy, the Rockefeller family is about to add another, the largest auction ever. In May, Christie's and the Rockefeller family will sell off the entire collection of the late David Rockefeller, who passed away last year at the age of 101. The sale is likely to set a new record for an auction of a single collection, estimated at more than $500 million.
Sold at $29 million.
In a rare interview at the family farmhouse in upstate New York, David's son, David Rockefeller Jr., said he hopes the family treasures will find new homes around the world.
I love the idea of thinking about these pieces in many other people's homes. It's like a grand recycling.
Aside from being the yard sale of the century, it's also a rare window into a family that, for all of its public good, has maintained almost obsessive privacy. David Rockefeller was the grandson of John D. Rockefeller, the controversial oil tycoon who became America's first billionaire in 1916. David was the chairman and CEO of Chase Bank and served on countless charities, museum, and educational boards.
I hope that many of the buyers will have that sense that they're buying stories and buying taste and buying something homey as well as something very beautiful.
Their unmatched flatware collection includes Napoleon's favorite sugar bowl and dessert service. There are rare Asian Buddhas, porcelain collections, and carved birds, plus family heirlooms, including a 13th century Syrian incense burner that sat on David Rockefeller's desk at Chase Manhattan.
He probably liked to burn incense every day to set the mood, right?
It would be great to think that.
This piece is expected to sell for, I think, over $200,000.
That's what I hear.
The star of the sale is a Picasso. It could fetch over $100 million. There's a Matisse nude that could sell for as much as $90 million, and a Monet that's estimated at up to $70 million. While David and Peggy always said they bought for beauty, not profit, their art also became a great investment.
My father, when he was looking back at all the sectors of his investment, his real estate, his stocks and bonds, his art, he actually had a colleague of his measure how well they had done as generic asset classes, and art won.
During his lifetime, David gave away nearly $1 billion. All the proceeds from the auction will go to a dozen nonprofits selected by David. The Rockefellers are now in their 7th generation. Their financials are kept private. Forbes put David's net worth at around $3 billion, but he was just a beneficiary of a trust that will now get passed down. David Jr. says the sale of so many family treasures is bittersweet.
There are members of the family who are really sad about that. I'm saddest about the idea of going into an empty house that used to be a beautiful house, full of all these amazing pieces of art. My dad taught me not to look back.
But you don't have to be a millionaire to live like a Rockefeller. David Rockefeller's martini cufflinks are being offered with an estimate of between $400 and $600. And these ceramic cheetahs are estimated at around $200. Christie's is storing most items in a secret Manhattan basement and is taking some of the top lots on a world tour. The auction house says the Rockefeller brand has global appeal and hopes the sale may even inspire today's new billionaires to follow the Rockefeller model.
I think it sets an example for rich Americans in terms of both being involved in business and also being involved in the community and understanding what a serious commitment you have to make things change in a positive way.
David Jr. said it also reminds us that while great wealth can come and go, noble causes endure.
If you get too attached to material things, it takes your focus off of all of the other important things in life, including relationships and global peace and all of those other important issues. So at the end of the day, it's not the things themselves that matter in life.
For Nightly Business Report, I'm Robert Frank in upstate New York.
So well said, right?
Absolutely.
Can't wait. Thank you for watching this special edition of Nightly Business Report. I'm Sue Herrera.
I'm Bill Griffith. Have a wonderful holiday weekend, everybody. We'll see you Monday.